Good afternoon, ladies and gentlemen, and welcome to the INCE Group PLC results presentation for the year ended 31st of March 2020. Throughout the presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd like to remind you that the presentation is being recorded, and before we begin, we'd like to submit the following poll. I would now like to hand you over to Adrian Biles, CEO, and Simon Oakes, CFO of the INCE Group. Good afternoon, gentlemen.
Good afternoon.
Thank you very much, and good afternoon, ladies and gentlemen. This is Adrian Biles, the Group CEO. First of all, what we are is a fast-growing, profitable international business advisory group with a strong legal component. Our results were published on Monday, and I hope you may have seen those. We do have a full social media profile. Obviously, we do want people to follow our activities and our progress. So we are on Twitter and LinkedIn, and our website is www.theincegroup.com. So a very short intro on me. I'm a city solicitor with 30 years experience. I went into business in 1994, and since then I've been running private equity transactions across multiple business sectors. I founded the company in 2013, and I own 16% of the shares.
My name is Simon Oakes. I'm the CFO and came into role in April at the start of this now financial year we're in. I joined the business just before the initial UK INCE acquisition in the latter part of 2018. And prior to that, my background as a chartered accountant is with the Big Four, EY and Deloitte, both in audit and accountancy and also in corporate finance.
So the financial highlights of the year to 31 March 2020. We're pleased with these results, a year of continued growth. £98.5 million of revenue, 87% increase on 2019. Operating profits up 72% at £26.2 million. Adjusted profit before tax, which is the measure of how we think we're doing, £8 million, up 36%. Net cash generated by operating activities, £14.7 million. Simon will talk more about that a bit later on. And earnings per share, 21% on a diluted basis. And again, Simon will say what that would mean on a like-for-like basis a bit later on. A net borrowings of £9 million, which does include about £2 million of operating debt, which would be things like financing our professional indemnity premium, which is a pretty lumpy amount, about £2 million. And that, I think, leads us on to the next slide. So our investment case, brand, the INCE brand is a premium brand. Geography, we think we've covered off certainly a good chunk of the geographies that we need in Asia, in Europe, in the UK, and in the Middle East. And scale, our business's scalability, it's scalable rather, it's grown pretty quickly year on year. We're on the path to £100 million of revenue, which we feel we would have hit in the year to 31 March without COVID. Our gross margin is improving towards 45%, and indeed is better than 45% in certain jurisdictions, and we'll come on to that a bit more later on. Overheads as a proportion of revenue are coming down towards the 30% target, and the balance sheet has been strengthened by our recent placing. The drivers of the business are the brand, which attracts high-performing partners, which attracts high-quality clients, and the market-leading reputation across shipping, trade, energy, aviation, and insurance enables us both to attract good people, top quality clients, but also to collaboratively sell across our geographies and across our service lines. The business, as I've said, is scalable. We have a very competent back office function in a low cost location, which is capable of supporting a much larger business. And we believe that if we continue to develop and produce higher levels of revenue, the operational leverage presented by our low-cost location, and our ability to support the revenue without taking on a similar amount of overhead will deliver value to shareholders and all stakeholders over time.
This has been another year of significant progress for the group. It's our first full year as an international group. And despite the COVID-19 impact, which did affect the business both internationally and in the UK throughout Q4, we see that the results we delivered in the 100 million are a very pleasing proof of what we set out to do for the year. As Adrian mentioned, the brand is attractive to outside parties, and we are able now to grow our business through lateral hires as a focus for future growth, and through organic growth by collaborative growth, selling services into the overseas offices that they previously didn't have access to pre the merge, and benefiting our previous Gordon Dad's Group business before it became INCE from access to those markets it didn't have previously. We've taken on a number of teams. When I refer to lateral hires, those are, we define that as any partner that comes into the business, either as an individual or with a team. And we talk about a top tier lateral hire being any partner that comes into the business with a revenue book of over 1 million revenue per year. We took on at the beginning of the year 3 lateral hires with teams in Hong Kong, and I'll come on to talk about them shortly. It's an example of the success that can build for the business. Our growth has been significant year on year, largely acquisitive, but you'll see this year there's a different mix, and we're moving more towards the stable organic growth we've delivered year on year and growth from these lateral hires. We also operationally have put time and effort into integrating the businesses to operate as one group under the brand, and have put work into the back office to make sure that the platform we've built is now fit for purpose for substantial growth without further investment of cost into the overhead base. I'll come to talk about that shortly. I think the other important point to make is that the fundraise that we did in February, which was really the last of a tranche of raises, both through debt and through a fundraise back in January 2019, is the culmination of the raises we needed in order to fund the different stages of the INCE acquisition, which was a complicated acquisition, split as it was between a UK acquisition in December 18 and then the overseas acquisition, which you'll see in the numbers right at the start of this year. That is now fully funded and has left us with a strengthened balance sheet, particularly going into the current climate where COVID has created some uncertainty, which we'll also come on to talk about.
So the impact of COVID-19, there has obviously been one. First of all, I'd like to say how pleased we are that the business has been so resilient and that the people in the business have worked so hard to maintain levels of income pretty well. And whilst we're 10% off our pre-COVID targets, we are ahead of the previous year. The people have been very resilient. They flipped over to home working or agile working very quickly. Or more or less instantly when that became necessary. And we have been aggressively preserving cash through engagement with colleagues, suppliers and stakeholders who've all cooperated in large part to enable us to get through a very difficult period. The Far East was hit first, obviously, and very early on, but then again has also bounced back reasonably well, and we're now trading ahead of or at pre-pandemic levels. We're encouraging agile working ongoing. We don't know exactly yet how the future will impact on our physical office footprint, but it is unlikely to continue at the level that it is. Certainly in terms of housing people 5 days a week in every jurisdiction doesn't look like a very likely outcome.
Moving on to the actual financials, there's a few slides now where we'll talk through the trading profile. I think the presentation here, as Adrian mentioned earlier, we look at adjusted PBT as the measure of the profitability of the business. And what that is if you look at the published financial statements, which take a particular form just because of the strictures of how we're required to present our audited financials, operating profit doesn't actually include what's called non-controlling interests. That is effectively the salaries of the individual partners in the business. Structurally, they sit in an entity beneath the group, beneath the top company in the group, and they earn their salaries on a variable basis based on the work that they do. So that is the model that we operate, whereby you get a level of income based on the work that you do and bill yourself as an individual, if you're a partner, and also on the fees that are billed to your client based on cash collected. And that is designed as a method to incentivize people both to be active fee earners themselves, but also to sell collaboratively and expand the services that are sold into their clients, because they receive income based on the services sold to the client, regardless of whether it is a service they then deliver. So we add in the line, you can see partner profit shares, which is the NCI line, and that is an entirely mechanical and contractual number, which we think should be incorporated when looking at adjusted PBT. The numbers for this year in terms of growth, previous years we've done a lot of acquisitive growth, and that's no different this year with INCE, but I think there are two important things to point out. One is we've continued consistent with prior year's trend to, in the underlying business, deliver about 5% organic growth year on year. This year is no different, and that is held up from the first half of the year results we published to the second half, despite the Q4 impact of COVID Adrian had mentioned. The other important point is that the comparable statistic for us in the market is organic growth comprises both the pre-existing business and the impact of any laterals, so people that you bring in but don't bring in through acquisition. We've stripped that out here with regards to the Hong Kong laterals. That is the 3 partner-led teams of 20 people that came in early in the year into Hong Kong, that were separate to the INCE Hong Kong practice we brought in and came in with new business. They delivered 7 million of revenue, so 14% of growth on prior year. And obviously, if you took them together, you would look at, on a comparable basis, 19% organic growth. We've just chosen to split it out because we think there is some differential there in terms of what that growth is. We've talked about gross margin, and we aim to get to a gross margin of 45%. For various reasons I'll come on to, we haven't quite got to 45% this year, but it did go up from the half year. And there are clear opportunities to push it up further, which I'll demonstrate in a minute. In terms of overheads as a percentage of revenue, we mentioned earlier that we've effectively invested in building a platform that allows us to significantly grow from here on in, and to grow without needing to do big execution risk and cost risk linked acquisitions. Lateral hires are much less cost in terms of bringing them in. You don't have all of the necessary costs of new offices, large infrastructure, or the complexities of merging in back office functions. So we expect over time to be able to bring back down that overheads as a percentage of revenue towards 30%. We're already on the way towards that. It's come down from the half year, as the first half of the year was slightly distorted by some of the run-on costs of the original INCE UK acquisition, the dual running costs of our old head office down on the Strand, and the new one in Aldgate Tower, which is the previous INCE office that's now our head office, as we weren't able to exit the Agar Street office on the Strand until around about November, and also the run-on of certain INCE administrative staff in London who were removed as part of the rationalisation of the business, because we keep the majority of our back office function outside of London, where there's a lower cost of delivery. But that run-on took some time just because of the practicalities of the redundancy programs, etc., that were needed to move those people out of the business. We will move it down to 30% over time. We talked about COVID and its impact in Q4. I'll talk about that some more. The main impact of it was on activity levels in the UK and on collections in both the UK and in the Asian markets. In terms of performance so far since then, things have somewhat stabilised. We are down against budgets for this year by about 10% for the first quarter, which is why we have withdrawn guidance given the current uncertainty in the market. But I think there are two important points to make with that. Number one, we are down against budget, and that budget is a pre-COVID budget that we prepared in January this year and included the kind of growth year on year without an acquisition that you can see from this data. And number two, that Q1 performance, although down against budget, is up some 7% against the equivalent from last year. So we are cautiously encouraged by the performance this year so far, despite the uncertainty that exists. In terms of the performance as a whole, I wanted to touch on the gross margin. Our gross margin does vary by region significantly. You'll see from the table on the right-hand side there that actually the UK is above the 45% target. I think the important point to point out is that the Asia gross margin is also above the 45% target. And when we took the business on, it was some way below that. The lateral hires I mentioned, who have effectively come in and delivered pure gross profit above a pre-existing overhead base that needs no expansion to absorb them, have driven that margin up. EMEA is at a lower gross margin at the moment, which is why I say when I look at our gross margin, we've got scope to get up above the 45%. That is consistent with where the Asia market would have been 15 months ago. When we took on INCE in the 2 to 3 years prior to us taking them on, the overseas offices in particular had been hard hit by a level of fee earner attrition, which the EMEA offices have not yet recovered from. We're in the process of strategically bringing people in to bolster that revenue, and that is the way we will turn them around. But obviously we're doing that within a phasing process, so we get people in at the right time that they can have a meaningful impact without excess absorption of net working capital. We should start to see that gross margin improve even despite COVID this year. I think the final thing to say on the different markets is that the effects of COVID have been very different on our different markets. The UK is slightly harder hit than other markets, and that's really, in our view, down to the uncertainties in this country compared to certain other locations. EMEA has not been nearly as hard hit. The situation with EMEA is that it's the structural issues that we need to resolve over time I've just talked about, and the activity levels in Asia, although collections are down and their lockup, which I'll come on to talk about, is up. The general trading patterns are still strong.
So if we can talk a bit about our revenue by sector, the shipping and trade and dispute resolution parts of the business, which make up the majority of it, both on an actual basis and as a percentage of total revenue, have held up well, both in the period and also in the current year. Clearly, shipping and trade creates opportunities in times of stress for advice to clients in respect of contracts which have not been fulfilled, force majeure being a particular reason for people to have disputes while before the pandemic started to settle down. It's really the transactional parts of the business in corporate tax and real estate which have suffered. But to be fair, that's not really 100% COVID-19 related. That goes back 18 months to 2 years to political uncertainty in the UK, Brexit, change of government, and other factors which have conspired to cause people who do deals to keep their money in their pocket rather than put it on the table. But we are starting to see green shoots in that area. We've got some entrepreneurial clients who are going shopping in September. We expect there to be some bargains and a reasonable amount of activity around, so we're looking forward to that. Family and private clients was slightly disappointing. It's a small part of the business, but important, and we're strengthening the management team with a new partner joining later in the year, which I think is a bit of colour on the parts of the business which are doing well. Disputes, good. Transactions, not so good, but it will come back. It has always bounced back in the past, and we expect it to.
Next, we've put a presentation of our cash flow. In any year when you're merging into nearly equally sized businesses, we accept that, and I know this from years of doing acquisitions and financial due diligence myself, the cash flow of any business doing that will be perhaps difficult to understand at glance in the statutory accounts. What I've presented here is a cut that takes the adjusted profit before tax that we look at as the measure of profitability, and then flows it down to net cash in and out there. I think there's two important points to make. One is the split of cash. So when we took on the INCE businesses for the overseas, they were not in a cash generative position at the start of the year, and we've had to do some funding of them of a significant amount throughout the year. At the year end, the split of cash on the 31st of March was roughly equal between the UK and the overseas, and that split has persisted broadly consistently since then. We were at about 6 million of cash towards the end of last week. The other point to make is that, we recognise that the cash flow is presented for this year because of COVID and because of the INCE acquisition is difficult to understand. What I've put into the text, you'll see on the left-hand side there, is the estimate we can do of what the impact of, first of all, the costs that we had built up that needed to convert and go out through the cash flow this year in relation to the redundancies I've mentioned, the dual run costs, the various legal and professional fees of the INCE deal had been. We had a large provision, you can see on a balance sheet last year, and a lot of that is unwound through accruals and provisions this year, and I estimate that at 6.6 million when we analyse it back to the actual items we spent. We then had to fund the INCE overseas offices net working capital for the period of the first half of the year, where we got them to a point where they were cash generative. That is, again, a necessary estimate, but it's about 6 million impact on net working capital. And finally, the impact of COVID to the 31st of March. I mentioned earlier what we saw in our Asia markets right after we'd done the fundraise late in January and prepared our pre-COVID budget that I mentioned earlier. The Asian markets largely went into lockdown, and our Hong Kong office went into full lockdown. We did think that would have some significant impact on activity at first, but activity levels held up. However, as you'll see on the next slide, what did happen was clients tended to hold on to their money, and debtor terms got extended there, and that hasn't fully unwound yet. There was some couple of million therefore of lockup that's above the normal level there. Similarly, in the UK, we did have an activity hit in early March in the first couple of weeks, really before lockdown came in, when there was a lot of uncertainty here, and people again held on to their cash. We also, unfortunately, in the UK for those couple of weeks, did see that activity levels dropped, which is largely where you see our revenue not quite getting to the 100 million, or we're getting very close, that we were planning to deliver. And that manifested in cash to a roughly equivalent amount in terms of a drop in collections at really our peak time of about 2 to 2.5 million. There was a smaller impact in EMEA, maybe to the tune of around about 500,000, but overall we had a 5 million impact on collections all told in that period of Q4, offset by some management of costs down of about 1 million. So taken together, the three big items that distort that cash flow, 4 million, 6 million, and 6.6 million, you would be adding 16.6 million to the working capital movement the other way, and it would be only a 1.2 million negative movement there, which is perfectly normal if you think of it in the terms of net working capital growth, and would be an extra 16.6 million at the bottom line. The cash flow since then and since March, it picked up again in the UK in the latter part of March, and we got back to the normal level of collections. It has remained slightly unstable, but we are still billing and collecting each month, and there is a level of activity. As I said earlier, we're actually ahead of last year's Q1 as a group, and that is you're consistent by entity. But we continue to monitor collections, and we have done detailed, sensitized cash flow forecasts, stripping right back those pre-COVID level budgets to ensure that we can manage our net debt position and our cash position across the group. As I mentioned a minute ago, we had 6 million of cash as of last week. Adrian mentioned earlier that if you look at the net debt figure we report, again, we're slightly fortunate to the hostage of how accounting standards require you to disclose things. Our debt position, or our borrowings as presented in the accounts, comprise our external debt from the banks, but also include some in-year funding we do of our professional indemnity insurance. We essentially take funding at the beginning of the year and then just pay it back in equal instalments throughout the year. So it completely unwinds in year, but we do that on a calendar basis. So about 2 million, as Adrian said, of that net debt is not really external debt. And as our internal measure, we would say our net debt position is about 7 million. We expected it at the end of the year to be 4 to 5 million. But obviously you can see with the COVID impact, that is where the differential is on that, from reports we were giving at the point of the fundraise. I just wanted to touch quickly on Lockup, so everyone is clear on what we're presenting here. Lockup is how we think about net working capital as a professional services business. Really, the key drivers of net working capital are debtors and WIP. Creditors tend to be much more stable, and a lot of our costs are staff costs, which translate to the to cash pretty much in the same time they would be booked into the P&L. When we say debtors and WIP, what I mean by that is your trade receivables, so bills to the client, and WIP being any time that a fee earner has put down onto a timesheet that will be billed to a client but is not yet being put onto an invoice to the client. And we target 100 days a month as our Lockup target. The comparable in the market, we can see from our peers, is they do 120 days. So we see ourselves as ahead of the market on that, but we still think we can bring it down more. We came in under 100 days at the end of the year this year, which again is consistent with what we thought would happen when we presented our half-year results. We were slightly above at 108 days at the half-year, but we expect there always to be a swing in the second half of the year in net working capital, as fee earners who are paid based on cash collections rather than bills strive to collect as the year goes in. I think the only other thing to say on this is clearly, as I pointed out earlier, our Asian Lockup is slightly higher than it otherwise would be, although there is, likely over time to be a slightly higher Lockup profile just because of the way clients tend to pay on slightly longer terms over there. And second of all, the UK Lockup is lower than we would normally expect, largely because there was that bit of lost activity in the first couple of weeks of March. We continue to look at our Lockup and manage it, and we believe, however, that we can continue to bring that Lockup down over time, and we are pleased that we've come out under the 100 days, especially in the circumstances of the strong headwinds we faced from COVID.
So our summary slide here in terms of key achievements, we've significantly grown the revenue since we listed on AIM. We've invested in the brand. We've valued the brand at £17 million in the balance sheet in these results. And we believe that it's worth considerably more than that, especially with the additional investment we've made in the brand and the marketing effort which goes into the business generally. The overseas offices are being rehabilitated quite quickly. We're very pleased with the way that has gone. And again, that's a reflection of the strength of the brand and the transparency and attraction of the remuneration policy. And we've been fortunate to recruit some top tier talent on the management side of the business who've got a lot of experience of running international professional services businesses. And the introduction of those people, and in particular Julian Clark, has really started to forge a common culture across the business of trust. Trust is at the absolute basis of collaborative selling. Collaborative selling is one of the keys to our future growth, and we're very pleased with the results that we've already started to see from that. So our people are our assets, our clients are our assets, our brand is a terrific asset. The geography, the offices, the spread of business lines and geography is exceptionally attractive to clients and to the people in the business. And we believe that as we continue to drive the key metrics of the business, the market will come to understand the business, to understand the value in the business, and that will create value for shareholders. Thank you very much.
Adrian, Simon, thank you very much for the presentation there. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd just like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Lastly, before I hand back to Adrian and Simon, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you will be redirected for that opportunity to provide feedback in order the company can better understand your views and expectations. Adrian, Simon, thank you for that. Before we look at the questions we've had submitted today in the live event, I wanted to ask you just a number of questions that were pre-submitted ahead of today's event by investors. Perhaps, Simon, I can start with you. You've had one question, which I think you pretty much covered off in the presentation, but I'll just say it and go through it again, please. But can you comment on the fact and agree whether you believe it's fair for shareholders that partners at INCE receive 16 million in bonuses, yet shareholders have not had a dividend reinstated?
Well, I think the problem we have with this is that there's a misconception about what NCI is. It's not some sort of minority interest bonus that we award to them. It's the contractual terms of their deal. So the partner's income is variable based on what work they do and what fees their client does. And it's designed around what we want is hungry, business development driven partners who will go out and win new clients and who will be proactive in delivering for those clients. And their remuneration, they don't take a salary as such. What they take is a variable remuneration based on that, but it's contractual. So it's not the same as some sort of bonus or dividend that we decide to give to the partners. It's contractually what they're due. And I would much prefer it if we were able to present a P&L where that was a line item in the P&L, as rather than this kind of confusing attributable to NCI at the bottom of the P&L that I know is not the cleanest or clearest thing.
Okay, that's great. Thank you. I think that's clear some of that up there. Thank you. Another question we had pre-submitted. Can you address the 9.4 million loss that was included within the accounts? No explanation was provided for this, and it spooked a number of shareholders.
Okay, so that will be at the bottom of the statement of financial position. Essentially, we're a multi-entity group, and different things sit in different entities. So what you are seeing here is the group numbers, which are the consolidated numbers of the group that investors own. The individual top company itself, the INCE Group PLC, is just a holding company and it bears various costs, but it has no income. You're required to disclose the sort of bottom line of its P&L, but not the details of its P&L. But you would see, if you saw a P&L, that it had no income and only cost in it, which is fairly standard and just an accounting practice. It has no bearing on, you know, the actual group P&L numbers, because the group P&L numbers that I'm talking about here are the numbers that investors own.
Great, thank you very much. And last one we've got here is, can the company update the market more often via trading updates?
I think it's something we'd like to do. We are trying to make sure that we're proactive with our investors in communicating with them. There has been some difficulty in communicating these last few months as we adapted to the new kind of mixed working in the office, working from home practices. You know, and as I came into role in the background of the real uncertainty that we did have with COVID starting in the year, but it's a fair question and one that Adrian and I are very keen to address.
Great, thank you. And just perhaps if we can turn to some of the live Q&A. I know I haven't given you a great amount of time to review the questions we've had submitted today, but perhaps if there's a couple of themes you may see, or some of the points you'd like to address, if you could just read out the question and just respond to it, that'd be fantastic.
Yeah, there's a question here I'd like to talk to, which is, are there any new business streams that you would like to expand into? Yes, there are. And I think that provided that we are able to do what we have been doing, which is effectively leverage the brand and the infrastructure by recruiting appropriate talent, then it would be good to be a bit more exposed to cyber, where clearly there's potential growth, and in particular, you know, cyber security for shipping companies and big logistics businesses who are our clients is a significant potential growth area. We're already advising on alternative currencies such as Bitcoin, and we're also advising on blockchain. But both of those are areas, I think, where the application of those technologies to some of our core service lines like shipping, logistics, insurance are going to be ongoing, a very interesting area for us to develop into. Simon, I think there's a good question here on deferred consideration.
Yeah,
which, I think it would be, yeah.
I mean, I think the other issue that we suffer from with the way we have to present things is deferred consideration. These are effectively the earnouts on some of the acquisitions that we've done when we bought businesses, and it's presented as a sort of hard liability on our balance sheet. And you know, fully accepted is a big number, but what it really is it is a turnover-linked earning that people who have come with the business will earn based on delivery of revenue going forward, and it is again a sort of proxy for salary for certain people in the business. So it's entirely contingent based on them delivering turnover metrics, which if they don't deliver, they won't get the consideration. What we do is we forecast them, and we forecast them basically to get the maximum of that they could get under the deals we deliver. So again, I find it is one of these things where, you know, we put in the maximum to avoid under accruing, but obviously if we pay out the maximum, that means that they've delivered the maximum to the benefit of us in terms of profit. And it's a slightly strange concept that we're stuck with this liability in our balance sheet that's really, if you think of it like that, a salary accrual, because it covers, you know, a number of years. So it's as if you would have accrued your salary for 2023 in your balance sheet, which, you know, under normal circumstances, you'd probably say I was mad for doing. But it is the accounting that we have to live with. And I realise it makes our balance sheet look difficult to understand, but it is purely contingent, and it requires delivery of levels of profit that, you know, we want them to deliver.
Simon, there's a question here on debtors, which I think we'd just like to go through in terms of our provisioning, which I'm not sure is we've properly explained. Yeah,
so note 28 to our accounts, the credit risk note talks about the split of debtors by age. We have a policy where we never write off debtors, but we do provide debtors, and we We believe it's conservative policy. We keep it under review, but we provide in full any debtor that is over 6 months old. Whenever we've looked at market sort of metrics, most of our competitors are providing for anything that's over 12 months old, and certainly the INCE business that we brought in provided for debtors only when they're over 12 months old. So we inherited a lot of debt that is, in that sort of sense, very old and fully provided. It will not have any impact on our cash flow, and it will not have any impact on our P&L if it's not collected. But the reason that we don't write it off is we do still manage to collect some of the old debts we've inherited with some of the acquisitions we've made. And also, providing against something doesn't mean we're saying in that sense it's gone bad. And I think, the profile of debtors of some of the parts of the business is that they do pay over a longer term. I think, Adrian, you can talk to some of the complexities of the P&I clubs that we deal with, where there can be a significant time over which you're actually collecting in the original debtor. And as I said before, certain of the practices at the moment, certain of our clients over in Greater China and Singapore are paying on longer term. And we've found in the last few weeks that previously provided items are starting to unwind cash.
I'd like to answer the question on territories and whether we would like to expand into any new overseas territories. I think there will probably be an argument for building on territories where we already are. So if you look at the Middle East, for example, Dubai, where we have a very strong office, is a very good staging post for the rest of the Middle East. And, were we to have the opportunity, which was, frankly, we'll have to pass a very robust business case investigation from our end. I mean, we're not going to do anything which is not going to have a pretty early payback. But I think as we are in the Middle East, in Dubai is a good staging post for example, Saudi Arabia. And I think the same is true for Singapore and the rest of Southeast Asia, where, there are active and growing markets. And again, Singapore is a great hub to attack Southeast Asia from. So I hope that gives you a reasonable comfort on that. Question on the market reaction to the results announcement. It has been a difficult reaction to understand. Our job is to deliver metrics in terms of the performance of the business, which will create shareholder value. And that's what, we spend all our time working to achieve. I don't think that Simon has touched on the deferred consideration, and he's also touched on the non-controlling interests, which are really basically partner income. I mean, they're not bonuses, they're not anything weird, they're just what the partners are entitled to as part of their remuneration package, which is based on what they produce. So, the fact that it appears in an odd line in the P&L account doesn't help us, but we should be able to explain it over time. And we are very conservative in our accounting, and I don't think that is necessarily a bad thing. We just have to work on the business, and we believe in the operational leverage model. The business, in our view, is a much better one today than it was 18 months ago. It's been robust during COVID-19, and we expect and anticipate that the next 2 to 3 years we'll start to see some superb results come through and see some significant cash thrown off, which in my view as a shareholder, free cash flow is the measure of success.
I think there's been a few other questions about the fundraise. And what happened with the fundraise. I think just to put it in context, when we did the INCE deal, we did it necessarily in 2 stages. We did the UK at the end of December 18, and then we did the overseas at the beginning of the 1st of April. And in between those, we had raised debt from Barclays as part of the UK side, and that is the external debt we've got, but that only actually covers the UK part of the business. It doesn't cover the overseas. And then we did a placing in January that only really covered, again, the UK part of the business, because it was a kind of debt and equity raise. And the reason it only covered the UK part of the business was that, our senses at the time that people thought that we wouldn't be able to execute on the second stage completion of the overseas. We did that. We've executed on it. They're operationally integrated and, a strong part of the business. But we knew then that we would need to go back to the market at some point. It became apparent because the absorbing that, the point I made about the working capital, etc., absorbing all those costs required some investment. And the fundraise, therefore, in February was in some ways backward looking, in my view. It was to cover the fundraising we couldn't do the year before because we couldn't prove to the market that we could execute, or we couldn't get the market to understand that we could execute on the second completion. So I think the point about I've seen the point, has it all been absorbed? It was always going to some extent to be absorbed. And therefore, our plan when we did it was that would happen, and we didn't plan therefore around a further fundraise. We are not in our plans at the moment looking at a further fundraise right now. We have done detailed cash flow modelling of both the UK and the overseas at a granular level to understand what we can manage through our cash flow if there's any further deterioration. And we have, as I said earlier, have done a detailed sensitised cash flow that shows us that we can, move through this. And I'm hopeful, as I say, the Q1 results are much more, when looked at versus last year, they are much more encouraging than we might have hoped for when we were looking at the start of the year in the early part of April with the uncertainty that was there then.
Thank you, Simon. That's great. Adrian, Simon, thank you very much. I think you've addressed those questions you can from investors. And of course, the company will review all questions submitted by investors today, and we'll publish those answered on the Investor Meet Company platform. Adrian, perhaps I could just hand back to you before directing investors for feedback, just to wrap up, please, and just remind investors of your summary. Thank you.
Yes, thank you very much. And thank you very much indeed to all who've attended. This has been a new experience for us. We hope that it's been useful for you. We think this is a very good platform, and, we hope we get a bit better at presenting to you. And, next time I'm sure, we'll have more people, and it will be hopefully as constructive, if not more so. Just to let you know, the investor presentation is on our website if you choose to go and download it and spend a bit of time browsing on it. We're always happy to engage with shareholders. So, please don't hesitate to get in touch. Thank you very much indeed.
Thank you, Adrian. Thank you, Simon. Thank you for updating investors today as part of your communication program. Could I ask investors not to close the session, as you will be automatically redirected for the opportunity to provide your feedback. If you access the meeting from our website, the feedback page will appear in front of you. If you've accessed via the link in the email, you'll be asked to log in and just to submit your feedback. So on behalf of the INCE Group and Investor Meet Company, I'd like to thank you for attending today. Thank you very much, and have a good evening.